When it comes to tensions between China and Taiwan, many people immediately think of military conflict. But for financial markets, this is first and foremost a story about money, supply chains, and economic power. On one side is the world's second-largest economy, a manufacturing hub for thousands of global corporations. On the other is a small island. In terms of land area, Taiwan is roughly equivalent to a single, relatively small province of China. More specifically, Taiwan's size is comparable to Hainan, China's southernmost island province. Yet Taiwan controls one of the most critical links in the digital economy: semiconductor chips. Political tensions do not stop at diplomatic statements. They have a direct impact on capital flows, trade, technology stocks, and global growth. In this video, we will analyze China and Taiwan through an economic lens: who is stronger in terms of scale, who holds the strategic advantage in the value chain, and why any instability in the Taiwan Strait can ultimately affect investors' wallets around the world. If we put China and Taiwan side by side economically, the first and most obvious gap is sheer size. China's nominal GDP currently stands at about $19 trillion, making it the world's second-largest economy and more than 20 times greater than that of Taiwan. To put it into perspective, China's economic scale is roughly equivalent to the combined economies of Germany, Japan, India, and the United Kingdom. Meanwhile, Taiwan's GDP stands at around $800 to $900 billion. Much smaller in size, yet it is classified as a developed economy rather than an emerging market. However, when looking at GDP per capita, the picture flips. China currently stands at around $12,000 to $13,000 per person per year, while Taiwan's figure is 2.5 to 3 times higher, hovering around $37,000 per person annually. This highlights that China's strength lies in scale and sheer volume, while Taiwan excels in quality and the value created per unit of labor. This contrast becomes even clearer when looking at the growth structure. China is a comprehensive economy, spanning industrial manufacturing, exports, real estate infrastructure, and domestic consumption. In manufacturing alone, China accounts for nearly 30% of total global industrial output. In return, however, China's growth relies heavily on investment, debt, and policy stimulus, making the economy more vulnerable when the cycle turns. Taiwan is different. Exports account for more than 60% of its GDP, with most of the value coming from high-tech industries. A very clear example is semiconductors alone, which contribute over 15% of Taiwan's GDP. Taiwan also produces more than 60% of the world's chips, especially the most advanced ones. In other words, if China is like a massive ship, then Taiwan is a small but critically important component in the engine of the global economy. And it is precisely this imbalance that makes any tension or disruption between the two no longer a regional issue, but a matter for the entire global economy. China is home to many large corporations, spanning technology, finance, and energy. Tencent currently has a market capitalization of around $700 billion. Alibaba is valued at roughly $350 billion, while state-owned banks such as ICBC and China Construction Bank each also have market capitalizations exceeding $350 billion. By contrast, Taiwan's market has far fewer large companies, but it is extremely concentrated. The standout is TSMC, the world's largest semiconductor company, with a market capitalization ranging from about $1,550 billion, higher than most individual Chinese conglomerates. TSMC alone plays a pivotal role in the global supply chain, manufacturing chips for Apple, Nvidia, AMD, and many of the world's leading technology companies. Beyond TSMC, Taiwan is also home to firms such as MediaTek, Foxconn, and ASE Technology, companies that may not be widely known to the public, but are deeply embedded in the technological infrastructure of the digital economy. As of 2025, China ranks second in the world in terms of the number of billionaires, with around 450 billionaires on the mainland alone, roughly 1 billionaire for every 3 million people. Meanwhile, Taiwan, a much smaller economy, has around 50 to 54 billionaires, meaning roughly 1 billionaire for every 500,000 people. If we place these two figures side by side, China has roughly 8 to 9 times as many billionaires as Taiwan. This reflects China's much larger economic scale, greater industry diversity, and far bigger domestic market. Although Taiwan has fewer billionaires, Its billionaire to population ratio is high compared with many other economies, reflecting the concentration of capital in high-tech and advanced manufacturing industries. Amid rising political tensions, defense budgets are a key indicator of how much priority each economy places on national security. We will compare the defense spending figures of both sides to better understand the gap between them. China is the world's second largest military spender, with defense expenditures of around $314 billion, accounting for roughly 1.6% of GDP. This shows that the economy is strong enough to sustain a large budget for military modernization. Taiwan's defense spending stands at around $16.5 billion, accounting for roughly 1.8% of GDP. In absolute terms, China's total defense spending is still more than 20 times larger than Taiwan's. While Beijing maintains a massive military budget to modernize its forces and safeguard strategic interests, Taipei focuses on defense, prioritizing deterrence capabilities and diplomatic cooperation. This is clearly reflected in Taiwan's defense budget, steadily rising as a percentage of GDP. Overall, China and Taiwan represent two very different models of economic power. China excels in scale, from GDP and population to its vast domestic market and ability to control capital flows and monetary policy. Meanwhile, Taiwan holds a critical position in the highest value links of the global economy, especially in semiconductor technology. It is precisely this imbalance that makes tensions between the two not merely a political issue, but a systemic risk to financial markets, global supply chains, and international capital flows. For investors, the key is not to predict conflict scenarios, but to clearly understand the strengths and weaknesses of each economy, so risks and opportunities can be managed with clarity and discipline. Markets tend to reflect expectations before they reflect events. And in the global geoeconomic landscape, China and Taiwan will remain two variables that the financial world cannot afford to ignore.